Coming up, the Australian share market slumps to a 3-month low. Investors now look to the US for the latest jobs report, and it's been a super year for super funds. The detail next. It is your daily 10-minute business and finance news wrap for this Friday, the 7th of July 2023. Later, super funds have had a pretty above average financial year. We'll tell you why. But first...
Now, Market Day on the SBS On The Money podcast.
The Australian share market had a pretty dismal day. The S&P ASX 200 down 1.7%. 7,042, that is a 3-month low, and it tops off a pretty ordinary week over the last 5 trading sessions, down 2.2%. All 11 sectors on the S&P ASX 200 finishing in the red. The worst performing sector, real estate stocks, down 2.7%, followed by consumer discretionary 2.4%. For the details as to why and where to now, I spoke with Luke Laretive, an investment advisor at Seneca Financial Solutions.
Look, there's government bond yields, which were sold off pretty heavily. Like the US 2-year bond is now back above 5% for the first time since the March banking crisis, and the Australian equivalent's now trading at 4.26%. That was up double digits overnight. Those spikes in yields came on the back of the June ISM services data, which was ahead of expectations at 53.9 points. That was up on May. That's the 6th straight month we've seen expansionary territory for that particular important indicator in the US. Kind of spooking investors and bond investors as well with respect to interest rate expectations. It's really the narrative at the moment. Rates need to go higher to curb inflation and economic activity.
Let's go into that in more detail in a few moments. But just in terms of our share market, where were the losses today? Because I think it was red across the boards.
Yeah, it was, to be honest, Ricardo. The market's down sort of pretty substantially across the board. As you can imagine, rate-sensitive sectors like technology, property, infrastructure, the worst hit, with Square, the Afterpay owner, being down sort of 5.25%, one of the worst performers.
Okay, so the challenge for the US Federal Reserve, we know there'll be some jobs numbers coming out of the US later tonight. There were the Reserve minutes earlier in the week which suggested rates need to go higher anyway. You know, how much higher, and what about the threat of a recession in the US?
Look, I think the threat of the recession is the question at the moment for investment markets. I'm sure rates will go higher, and it is a question really about what pace and for how long they stay elevated. I think the key bit of data is this ISM data that we have seen this week is that prices paid have actually continued to decline, and that deflationary momentum has continued to build. So while the activity and the output and the expectations continue to rise, and we may see sort of a bit of volatility in that, whether that spikes up or drops down, the disinflation narrative and the disinflation in prices in the US is continuing.
What about here in Australia? What does it mean for the Reserve Bank of Australia here?
Look, aside from the currency, not a lot for Australians per se. The RBA is clearly on a path of getting interest rates back into their target band of 2 to 3%. And, you know, we're going to see rates move higher here as well. It looks like at the moment on market consensus expectations towards the end of the year. But hopefully it's going to be at this more moderate pace, which we have seen over the last few months.
There are other concerns though too, because it's not just global interest rates, it's China. China's economy looked like it was going to come out of the prolonged COVID shutdown pretty strongly earlier in the year. Then it hasn't really happened, right? How do you feel about it?
Look, China's a bit of a black box. On one hand, you've got President Xi saying they're going to speed up stimulatory activity. You've got the Chinese PMIs in expansionary territory earlier this week as well. But on the other hand, we're hearing rumours about Chinese banks that are cutting bond purchases in Shanghai, which is going to be more of a contractionary policy. So, as always, it's a little bit of a mixed bag and a little bit of a black box, a little bit of uncertainty. So we'll just have to wait and see how that situation plays out in China.
So while the Australian share market started the new year pretty strongly on these hopes, predominantly on China's economic reopening. If you were to draw a line through the way it's been travelling since then, it's been trending down, right? Is it a bad omen for the way the market will play out for the rest of the year?
Look, I don't think so, Ricardo. Like, we've had a really strong year, financial year to date, FY23. Our flagship product was up 19.5%. The market more broadly is up 15%. So I think a lot of investors are really sort of still anchored to this FY22 period where we did have a lot more volatility and returns were difficult. I think it's this sort of seismic shift in interest rates that caused that. That is, as we say, now largely over. And I think we're going to see this more moderate, normal market conditions from here. And that stability is going to be supportive for equity markets and risk appetite for investors. So I think whilst there has been a bit of a negative bias, sideways market for some period of time now, I do think that things are looking up.
Okay, so if they're looking up, where are the opportunities for investors?
I knew you were going to ask that question. Look, we're always looking for opportunities across the market, but right now, like our quality small cap fund, we've got that many ideas at the smaller end of the market, and these aren't necessarily pre-revenue or speculative opportunities. That they are actually growing, profitable businesses that are trading at 40 and 50% discounts to our fair valuation. So I think in the smaller end of the markets, where investors want to be hunting.
Luke Laretive there from Seneca Financial Solutions. Now, what does it all mean for your superannuation? Well, the team at SuperRatings says in the lead up to all this share market volatility, it was a good year for superannuation. June, the median balance fund saw a return of 1.2%. And for the financial year, there was a gain of 8.5%. And that's above the long-term average of 7.1%. So where to now? I spoke with Kirby Rappel, Executive Director at Super Funds. Kirby, how would you describe the performance of balanced super funds over the past financial year?
I think reassuring is the word I think that we need today. So I think we've been pretty uncertain times. There's a lot of pressure around inflation and what markets are doing day to day. And so to see Super post a return around 8.5%, I think that's a great outcome for most people.
So what drove that 8.5% gain?
So the 8.5% gain for the year was driven by really strong outcomes across both international and Australian shares. That's about half of most people's portfolios. And at the same time, a bit better cash return, but a bit of a contribution across the board.
So for those unaware, you look at the balanced super fund. Why and what is it? And I guess how many people are invested in one?
Yeah, so for a lot of the largest funds in the country, they give you a default style My Super option. And that's usually a balanced style sort of fund. So about 70% in growth assets across Australian shares, international shares, a bit of property, fixed interest in cash. So that's where a lot of people, it gives them a bit of a good feel for where they may sit. And they've performed really well. So since 1992, it's about 7% per annum. And so we sort of outperformed that trend a little bit over the past year with that 8.5% return.
It's interesting talking about super today. The market's really taken a hit because of expectations of higher interest rates for longer, not, I guess, necessarily just in Australia, but around the world. There's a lot of volatility. The market's down around about 1 to 2% today. It was down 1.2% yesterday. Are there fears returns may not be as high in the short term following that 1.2% gain that we saw in June?
Yeah, I think you've really encapsulated what the challenge is at the moment. People have sort of got used to less volatility in the world. It's re-emerging again. I think it's going to be with us for a while. Over the long term, if super's ever hitting 7% a year, we should all be pretty happy. Sometimes it will, sometimes it won't. And the most interesting thing to me is it's the times you don't expect it. A year ago, we probably didn't expect that 3% fall. Right now, we may not have expected that 8.5% gain. So it is about that long-term view. People should stick to the long term.
So reiterating, what is your message to super members right now? Kirby, how would you... Kirby Rappel there from SuperRatings. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any